Many investors are wondering if the stock market is about to crash. A huge market correction could be imminent, and it could very well be that this is the final phase of a bubble. In fact, all markets are relatively high, and specifically the US stock market, but also the crypto market, is at historical highs. Now, especially US stocks are naturally driving the market, pushing up. Trump has come to power. Various snacks, statements, but also, for example, 500 billion in investments in new artificial intelligence projects, including, of course, countless data centers that need to be invested in and built. And US stocks just keep rising. In this short video, we're going to take a closer look at US stocks. And we mainly see that the S&P 500, as an example, is at historical highs. And it could very well be that a huge market crash is coming, but of course no one knows. And so it could indeed probably be the final phase of a big bubble. And at some point it has to burst. And that is of course the ultimate question. Now, as a beginner investor, it might be a bit less interesting. Why? You might as well just start investing with a very small amount. It has psychological benefits that you start investing. If you're a larger investor with more capital, then it is indeed relevant to take a look. I still want to have a lot of money allocated in America. Or is it wise to allocate more money now to, for example, other investment markets that are relatively cheaper? Those are all good questions. And in this video, we're going to take a look at the S&P 500. How is it looking? What is the potential return? And what can we perhaps expect for the coming years? There is a time to buy and there is also a time to sell, or at least to reduce positions. And I think this is such a time when you want to reduce your positions. We're talking about the S&P 500 that might crash. Yes, that's right. I personally invest in the Invesco QQQ as an ETF, if I already invest in an ETF, because I don't have many ETFs in my portfolio, those that are mainly filled with stocks. But we're going to talk about the S&P 500 in just a moment. However, I also like to show what I do myself. Because yes, that's proof, isn't it? And that doesn't always turn out well. I also often show my losers. But this is what it's about right now. Is the S&P 500 going to crash? Yes or no? And the chance is very plausible. But the exact timing is always very tricky. I last bought more QQQ in 2022 and recently sold a lot as well, mainly starting from 2024. In hindsight, it seems too early, but you see quite often it just means reducing positions here. And what have I done? I bought another ETF, namely China. I'll show that in another video. So definitely check out that video with an update on the latest ETF I bought for 2025. And I always show my stocks every month, see the portfolio. So make sure to check my channel regularly or subscribe if you want to stay updated on the portfolio updates. And just a spoiler alert, I don't have many stocks, mostly from America. Maybe I'm too early and it will hurt me, but I don't think so. Because my wealth has grown to such an extent that I am already financially free. I have a mindset that I don't need to have that much money. So for me, that's actually just fine. So the only thing I want is to not lose, not too much. At least not lose too much. And I think if you invest a lot of money in America now, you might still having one or maybe 2 good years, but it can't just keep going like this. Then you think, Jorik, what are you getting all worked up about? Well, it's just a rising line. Here we see a sticky example, SPIJEC. And as an example, let's take the SPDR S&P 500 ETF. Indeed, a gigantic line. The last significant drop was from 2022 to 2021, but that was only about 25%. The Corona crisis was about 30%, but that recovered quickly. Recent investors saw a steep upward trend. It was different before, a sharply rising trend, but it has been different for a longer time. We see here the dot-com crisis, and since then it has dropped by approximately 50%. Then you think, yeah, no problem, it recovered after that. Well, actually not. So about 8 years later, you actually just had a gain 4%. So as an investor, you have a really bad result. Why? That inflation is still going to come down. Is that inflation still extra high these days? So this was a really bad investment to buy at an all-time high during the dot-com crisis. And then it also dropped again during the financial crisis by about 50%. When should you buy? Simple. When there are bigger dips. And you can't always time that, so you have to be careful, and especially buy when the market is falling. And to be able to reduce your position when the market is rising again. It sounds so simple, but it's really hard to time it. So the only thing you could do, if you definitely want to achieve high returns or reduce risk, is just gradually taking a little bit each time. Taking profits. Take a little profit each time. Has the stock market dropped in this case from 2022 to 2023? Then you just buy every time at all. Or let's say minus 10% or minus 15%. And if you just keep repeating that cycle, then you increase your return in a very simple passive way. Just with one ETF, in this case, the S&P 500. And you can keep repeating that trick until you're a millionaire or much more than that. And you can then invest that money in more freedom or for your family or for higher goals, your ideals, whatever they may be. You let money work for you in a very simple way. It doesn't all have to be very difficult. But what's difficult is the daily emotion that comes with it. And guaranteed, you will see this video is early 2025, that this will be a great year for stocks, especially in America. You'll see it all. But I have serious doubts. The S&P 500 PI ratio is currently rising to 30. It doesn't happen very often that a PI of 30 occurs. You see that the median is 15. So the normal price to earnings ratio is around 15 and the average is 16. But that's over a very long period of time. Is it different now? Yes, definitely. Because the S&P 500 mainly includes the big players like Apple, Nvidia, Microsoft, and Amazon. And these are indeed great ones. Stocks. Only a price to earnings ratio of 30 is indeed essentially very high. Then there needs to be higher profit growth to justify that, and it could very well be that a downturn is coming now when prices are higher or much higher than normal and a downturn is approaching. Then cash will be extra heavy because stock investors, especially Mr. Market, are looking at the short term. Should you be worried as a passive global investor looking at the market in the short term? Should you be worried as a passive global investor? Maybe why we see a different graph here. The stocks of America, the price adjusted versus the rest of the world. And then you see that it's really at an enormous peak versus the rest of the world. And this hasn't happened before. Even during the internet bubble, this was a different story. Let's look at another image. And that answers the question, should you be worried as a passive global investor in price? Shouldn't I do that? I would just buy more. If I were to buy one global ETF and I would just passively buy more, should I just log in every month and buy a little more? And especially when the stock markets are falling, should I actually buy more? But maybe it's time now to wait a moment and to see what is going to happen. Why? You see that US equities are making 7 or even 73% out of the total weighting of a global index. That's really very high. So if the stock market of the S&P 500 or the QQQ or America in general is dropping, then that has a huge impact also on, for example, a global ETF. So yes, you should never scare yourself. It's just money. It's just a game. But it's nice to be here to make a bit of an assessment. What's going to happen? But a very big important, the warning is that forecasters are always wrong. And I'm not going to make any attempt to predict what the stock market is going to do. The only thing I think is that I want to reduce my positions in America more now, and I want to invest my positions more in other stocks that are, for example, in Europe, or for example, in the latest Internet on ETF that I bought, but not in the Nasdaq, but in China. That's what I do myself because I just think, yes, we also have growth prospects, only the valuation is a lot lower. So then one might global crash. So if there is a global crash coming, then the impact on lower, cheaper assets with good potential will be less. It's just that simple. And when does the crash come? For example, with those big tech companies like Apple and Nvidia, if it ever comes, then you can, of course, buy more. Well, the S&P 500 remains a very strong ETF. Let's make that clear. Apple, Nvidia, but also, for example, Whatcom, by the way, a stock that we advised in 2022 within our value stocks. Check out our website for that. For €99, you get access to our individual stocks analysis. And Broadcom has achieved a return of, in the case of the iPhone, I believe 300%, maybe even higher, incredibly risen. Also, of course, based on the developments in artificial intelligence. So that is now also part of the top 10. After that significant increase, if we look at example, the Apple valuation, it seems very high. Point your earnings of 30, but there isn't a lot of growth to counter that. So then you get an unlucky ratio that doesn't look good at all. An unlucky ratio that takes into account the EPS growth for the next 5 years. So if the company starts making more and more earnings per share for the next 5 years, that's positive. Only if the current valuation is very high, then the impact of that is less favorable. So a bad luck ratio below 1 is very cheap. For this kind of stock, but for a company that isn't growing as quickly, you always want to have a bad luck ratio below 1, right? For an Apple, you might say below 2 might still be okay depending on the situation and your insights, but 3 is relatively high. Nvidia has a super high valuation, price and earnings of 48.80. Nvidia has potential for enormous growth. Potential, of course. Only in this model, even though a growth forecast of about 100% revenue growth and a profit growth of about, let's take a look at the EBIT from 140%. So that's obviously huge. But you see such gigantic numbers for such a large company worth more than 3 trillion. 3 trillion, really gigantic. Yes, it could be that the forecast is off. You have to be huge. Create a lot of extra sales to achieve 100% revenue growth. If you already have a revenue that is super high, then now the price to sales ratio is actually 30. So the market value is not in millions. So then you divide that by 30 and you get the revenue because the price to sales ratio is 30. But these are extremely high ratios. And Nvidia is a super amazing top company. I also had it in my portfolio for a long time. Also shared. Unfortunately sold, really a stupid mistake, but it's been a long time since I sold it. And that is actually true. Lesson learned, never sell your winner is too early. So when is the right moment to sell then? If it just keeps going up and the valuations become really very high, then I would start to worry a bit. Microsoft, the same story, and the church ratio is still not too bad. Of course, all these companies score high on profitability, and that's an important point. All these companies are rightly so, high at the top on holdings of S&P 500 because of those high profits they are realizing. We actually see the same with Meta platforms, but the price to earnings ratio still seems to be okay for Meta. And we see Tesla with a super high valuation, really extreme, and the price to earnings ratio is above 6. And yet people keep investing in this. Yes, I do believe in Elon Musk and in the culture, and it's a great company. Tesla is more than just a car company. I believe all of that too. Only this is really just a bit of hype. Hype that you also see in the crypto market. The crypto market has risen enormously again. The crypto market is by far an example of speculation and hype. And especially when everyone is greedy, the crypto market is starting to rise. The same goes for riskier growth stocks. And I don't believe any of this fear and greed index that it's neutral. I don't believe any of it. This is just, I bought in Ethereum in 2017. I experienced that huge peak. I was still young then too. And I've invested before because I've been investing since I was 23, but I've also experienced that huge peak and that massive drop. I always held on. I sold somewhere in 2021. I don't remember exactly when it starts. I think in 2021, I'll show it to you and share it with you. I think that was still through Binance, even, and what other older platforms, of which a few don't exist anymore. It's gone. Points, that's another thing, but that should be manageable throughout the day. Yeah, I don't do much with the crypto market myself. I do keep an eye on it. I keep following it. It's such an interesting market, and the blockchain is amazing. It's just about what this is all about. The message of the story is not against crypto, not at all. The crypto market is just an example of hype and speculation, and when it starts to rise really quickly, that means the end. For me, that just means one of the last phases in the bubble. The chance that it will go up or go down, I think it's really big that it will go down. If we look at the valuation of the S&P 500 ETF, and this is ultimately what it's about, we see, in this case, I'm using fast graphs as an example. Again, this is purely for indication. Forecasting is generally often inaccurate, but it's still good to know what we're talking about. This data model runs up to and including 2005, so for 20 years. And what we see here is the black line is the price development, and the orange line is what would be seen as the fair value line, the normal or valuation line. And that is actually always the price. Profit equals 15. And here you can have the criticism. Well, listen, the price to earnings ratio is a median of 15. Historically, 15 is just neutral, average. And everything below that, like after huge declines, for example, in 1980, everything below that is a huge buying opportunity. But okay, we're now in the year up to 2025, and we see great stocks with great earning models. We can't be beaten anymore in principle, unless the government does something. So it's a different scenario than the PE. equal to 15 in, let's say, 1900, of course. That's not comparable to each other. So we need to take all of this with a grain of salt. Let's actually zoom in on, for example, the past 7 years. So over the past 7 years, we actually see an EPS growth here, and then the model actually carries that through to the analyst forecasting up until the end of 2027. And also what we actually see here is now that the price has been above that price to earnings of 15 for quite some time. But it follows a different line, namely this blue line, and this blue line is the normal multiple. In other words, the average price to earnings multiple that the stock market has paid over the price range of the past 7 years paid. But that doesn't mean that the normal multiple is also correct. The normal multiple, for example, over 11 years, that's a bit lower. As you can see, the price to earnings is 21. Looking at the past 20 years, then we see that the price to earnings has dropped to 20. So what could this mean? Oh, a price to earnings of 25. For an ETF, I personally find that a bit on the high side. Even if we stick to that normal multiple, then it would be a normal multiple of 23 over the past 5 years. But let's be a bit more cautious. We're taking a price earnings of 20. After all, the S&P 500 is still a strong ETF. Great companies. Yeah, I don't see much risk in it either. But that's the whole thing. If people don't see the risk and something happens, a black swan event, yes, then you might unexpectedly encounter significant dips. Of course, that creates a huge entry point, and many people will do that. So the coronavirus crisis was also recovered from very quickly, but you never know what will happen. Being a little cautious can't hurt, and that doesn't mean you should sit 100% in cash. I have quite a bit of cash in my portfolio right now, I must say, but that's also because a lot of money has recently come in from my business. But let's say, for example, you have 20% cash and 80% invested in your Ash portfolio. So 80% is invested, and you still have a portion of your free assets. Yes, in that. Then you need to think carefully about how much you want to keep in cash and how much you want to invest, because timing the market is really tricky. The higher the valuation goes, the smarter it is to take some profits, and then just keep it in cash or in savings. Depositors with lower interest rates, but also with lower risk. That's a bit of the message I want to convey. Finally, we see that the price to earnings multiple has risen to 25. Let's assume a price to earnings ratio of 20. Here we see the profit growth estimates of the R ETF on average. No idea how they do that. Let's assume for pure inspiration and entertainment that all of this is true. What isn't, but let's assume it for a moment, because the price to earnings ratio is now higher, 25, and the profit growth looks good, 15%, 13%, and then 6%. But the more normal valuation would be a price to earnings ratio of 20. Isn't that profit growth enough to compensate for those higher prices? At least not nearly enough, because the total average annual return would be about 5% in this hypothetical situation. When would investing in the S&P 500 still be interesting? Well, if the current price to earnings ratio is 25, these profit growth expectations shown below the screen need to be realized, and the price to earnings ratio remains at 25, for example, even after 3 years, which will undoubtedly fluctuate with peaks and valleys, then you could achieve an average return of 11%, which is actually quite fine. So yes, based on a bit of forecasting and depending on your assumptions, you can see I'm assuming, for example, a PE ratio of 20, or I'm assuming a PE ratio of 25, or I'm assuming a profit growth of 15%, or 10%, or 5%. Everyone has assumptions, everyone has insight, and that's why it's so difficult to time the market, because no one knows. That's just the reality. So the easiest way to deal with it is to say, yes, if everything has risen a lot in a short time, which is clearly the case as we see here, then you might as well just take some profits. Come on, a lower risk, and you've already taken profits. That's the whole goal. It's not about achieving the highest return. You're only focused on yourself. You don't need to compare with other returns. It's all about your financial plan. And if you're happy with, for example, a 7% return over 20 years, then you definitely don't need to take unnecessary risks right now. Then you really only have your mindset and your return objectives and time in your favor at this moment. So it's very difficult to time the market, and I'm really wondering what's going to happen. Exciting times again. That's how it always is. Keep following us. I will definitely provide regular updates on the S&P 500, the Nasdaq 100, but also on the stock market and specific stocks that might still be interesting at this moment. I would say see you next time.